Hello, everybody, and welcome to the Future Proofing Finance podcast from the CFA UK. I'm your co-host, Ben Ashby, and I'm joined by
Tom Threlfall from Sydney today.
This will be a very special episode because we have a very special guest. We have Nobel Prize-winning economist, Professor Paul Krugman. Paul is also a university lecturer, and he has been since 1980, and he's an opinion writer for the New York Times. And now he's on Substack, which is something we hope to discuss later on as well. Today's episode, as you can hopefully see, is also a video podcast. And because we don't want to waste what Paul has to say, there'll be an extended cut available on the CFA's website. The link for that will be available underneath this podcast. So, Paul, welcome. Thank you very much.
Hi there. Good morning, from my point of view.
So we've got a lot of questions to ask, as we've sent some over. The first one was just, how do you see the world at the moment? What do you think is likely to happen next? And this week's lottery numbers would be fantastic as well.
Yeah, I mean, my basic forecast for the world is God knows. It's wild. I mean, if you had, we basically had more policy action, more crazy stuff in the past 4 months than in the previous 4 years. It's just a wild roller coaster. Just before we recorded this, suddenly having imposed completely prohibitive tariffs on China, Trump just said, "Oh, never mind," and brought them way back down. And so, wow. I think the thing you want to say first is that I mean, tariff policy is still at the center. I think some other things will start to become bigger deals in the months ahead. Where we are right now is that the United States has imposed tariffs that even after the big tariff cut on China announced just before we started, are still much, much higher than they were before. Just quick back of the envelope, the United States now has the United States came into this with a average tariff rate of around 3%. I'm pretty rough guess now is that it's about 15 on average with the reduced China tariff, which is that's in the past that we would consider that a huge tariff rate. It's not that far below the average tariff rate after Smoot-Hawley in 1930. So we're still very protectionist. So the first thing is, wow. Much more protectionist than before. And everything is explicitly and also in reality provisional. All of the tariff rates currently in effect are supposedly only good for the next 90 days or less than some of the others. And what's going to happen when that time period expires is anybody's guess. So we have a far more protectionist environment than we did just a few months ago, and an infinitely more uncertain environment than we had just a few months ago. And that has to exert some, how can businesses plan in this environment? So it's a tremendous amount of uncertainty. We're still waiting for some other shoes to drop. Again, the United States is currently the epicenter of the craziness. That's new. I mean, in the past, crises tended to happen in emerging markets or whatever, but now it's really the U.S. that is the big disturber of whatever it was you thought were the rules of the game. But the United States is, they're still talking about really large-scale deportations, which, if they happen, will have huge impacts on labor supply, especially in certain sectors like agriculture and construction. And we don't know what's going to happen to monetary policy. We have a president who's simultaneously yelling at his central bank head and also saying that he won't fire him. So what happens? So I think this has got to be a drag on the world economy, although maybe not as big a drag as we were expecting 12 hours ago.
You've made mention in some of your recent publications about the chance of a recession. Do you think this is a consequence? I mean, the betting odds, for what it's worth, have them at about a 50-50 coin toss. Yeah. What's your view on whether the current state of tariffs could lead to a recession?
Okay. Funny thing is that tariffs are not normally things that cause recession. You export less in a world of protectionism, but you also import less, and the net effect on demand is normally kind of a wash. What had us, I mean, I've somewhat marked down, in the last few minutes, I've somewhat marked down my recession odds, although I still think it's more likely than not. And there's really two reasons why this might be, why this time around tariffs might be recessionary when they aren't usually. One is just the extremity, the size of the jump in tariffs. This is, even if we're now 15% average tariff instead of what it was probably 25 before the latest announcement, going from 3 to 15 in 30 seconds is that's a real shock to the system in a way that a gradual ratcheting up of tariffs is not. And it means shortages of goods on the shelves. It means a lot of stuff that is too expensive to import, but it's too soon to produce domestically. So that's a real negative. And then just the sheer uncertainty. If you were a business, I mean, if you actually already made investment plans based on 145% tariffs on China, and now it's 30%, then you made a big mistake. But if you make investment plans based on 30% and next month it goes back up to 145%, then you made a big mistake. So there's a real incentive to just sit on your hands. And you can see that on a bunch of fronts. I've actually been looking at at some leading indicators like oil rigs. You can already see that there's a real chilling effect on investment already. So a recession it takes a lot to tip an economy that was growing solidly until Trump took office. It takes a lot to tip that into a full-blown recession, but it still seems pretty likely. And stagflation is a significant risk because of the combination of the uncertainty weighing on spending and the tariffs driving up prices. So it's still pretty ugly, though maybe a little bit less ugly than it looked yesterday.
As you know, Trump's released the skinny budget, though there's so little detail in it. Skeletal might be a better one to describe it. But could you see the US market potentially having a sort of Liz Truss type moment like us Brits did, where the bond market just has such a fright that it can't deal with whether it's the funding requirements or anything? And medium term, can you see us moving into a world where there's basically a lot more fiscal discipline around Western governments?
Well, it's certainly possible. I mean, the skinny budget, anybody, I guess the audience for this will know what that means, but it's really a budget for only a small fraction of the United States of federal spending. Most federal spending is entitlements, which really sounds like it's a privilege, but it just means things that don't have to be budgeted every year. So, but the stuff that was on the line, which was discretionary spending, is around a quarter of the budget, almost half of that defense, which was actually increased. And the other part being NDD, non-defense discretionary spending, which is 14% of the budget, and has been squeezed for many, many years. So it's actually not there's not a lot of bloat in there, and yet they were calling for a drastic cuts in discretionary spending, which would bring discretionary spending down to levels that we've basically never seen. It's basically not a return to the 60s or the 50s. It's a return to Calvin Coolidge, and that's not going to happen. That's impossible. That would mean I was going to say crashing planes, although we're kind of getting that anyway. It would mean inability to just carry out the basic functions of government. When it becomes clear that they're relying on that, or that any pretense of fiscal discipline depends upon pure fantasy, you could see it happening. Now, what happened in the Liz Truss moment was, it was an irresponsible budget. It was also a signal that we were not dealing with serious people. But of course, that's if you haven't figured out that in the U.S. we're not dealing with serious people, you haven't been paying attention at all. It kind of metastasized because of kind of technical stuff, largely involving pension funds. And there's at least some possibility that we'll see that kind of balance sheet amplification effect in the United States. But I mean, the thing about Liz Truss moments is that they're very hard. They're basically, if it was obvious how they were going to happen, they would have happened already. The risk seems very real, and I mean, it's only one of multiple things going on. But yeah, the United States is still, to a large extent, we're living off the credibility of 80 years of pretty reasonable governments. Even the ones that we thought were fiscally irresponsible were not very fiscally irresponsible, and nothing. There's nothing like this. I mean, this Trump is making Reagan look like a paragon of fiscal rationality.
That ties in beautifully with my next question, which was going to be, you've written about the similarities between the Reagan era. And to cut to the chase, really, the biggest downside is becoming less investable. By destroying America's attractiveness to foreign investors, basically, what effects might that have?
The U.S. runs a trade deficit, which is persistently high, but that has never been a problem. The trade deficit is only a problem in some people's minds because it's been easily financed by inflows of foreign money, mostly not. I mean, there's a certain amount of people accumulating dollar reserves because it's the international currency, but mostly it's businesses. A lot of it is direct investment, a fair bit of equity investment, all of which is driven by. Well, the U.S. is a big, rich economy and a very successful economy. We've GDP per capita since 2000 has risen something like 35% in real terms, compared with around 20% in the euro area. The U.S. has just kind of pulled away from the pack in terms of productivity growth, technological progress, which brings in money. And the counterpart, the balance of payments always balances. So the fact that foreign capital is flowing into the United States means that we have a trade deficit. The trade deficit is, people think that it's funny when you say this, but it's a sign of strength. It's because the world has thought that America is a great place and good place to put your money. That actually the way that works is through a strong dollar. So the U.S. has a strong dollar, which means that our manufacturing is somewhat uncompetitive, but all of that's the counterpart of America being a good place to invest. Is this still a good place to invest? We have pretty bizarre policies, and this is where the political side also comes in. I mean, if you were a European business person investing in the United States, and you want to visit your investments, what if you get stopped by Customs and Border Protection and it turns out that you said something critical about Trump on your phone, right? I mean, this is. I'm sorry, this is not a political talk, but it's clear that there's a level of risk now just in dealing with the United States that wasn't there before. And all of that has got to have, over time, a chilling effect on foreign investment in the United States.
Can we just talk about Europe? As you rightly point out, the US is doing fantastically in terms of technology. And I know we've discussed this offline previously, but Draghi came out with a report recently. It's, to my knowledge, it's at least the fourth report that you've had from the European Union about things aren't going well. We need to reform things, that we need to restructure. Do you think it's something that the Europeans could catch up with? Why do you think that the US has been doing so well in technology? Is this just one of these unassailable kind of clusters that cannot be caught up. I know you've written on your Substack on some of this, but it'd be great if you just went through some of the key points.
So the first thing that everyone should understand is that when you try to explain why productivity growth is higher in some countries than in others, the usual response should be, if you ask what do economists have to say about it, for the most part the answer is nothing. Long ago, my old teacher Bob Solow said, it was actually specifically talking about the UK lag, and he said that every attempt to explain it ends up in a blaze of amateur sociology. We really have a hard time making sense. There's a lot that we just don't know. To the extent that we can make some sense of this, you can point to a bunch of things about Europe. The regulatory burden is higher. The European, even though it's a single market, in a lot of ways it isn't. There's still a lot of restraints. It's not a fully integrated market. That has to have some burden. There may be some other issues like a significant part of U.S. technological success has involved the interaction between business and research universities. And European research universities are still, they're better than they used to be, but there's still a kind of inflexibility and hierarchical nature and lack of integration with business. And infrastructure has been neglected. It's one of those shocks to just try and take German trains. And if you think that Germany is the land of efficiency and everything works, well, no, actually not anymore. They've underinvested, clearly. So all of that is real, but a lot of it, and this has been my kind of thing that not many people are saying, but I think it's really important, is that productivity differences between countries, especially between advanced countries, are often just a few sectors. And a lot of it is just plain high-value industrial clusters. In the case of the United States, the numbers are flaky, but as best I can make out, about half the difference in value added per worker, average value added per worker, is really just Silicon Valley and a little bit of Seattle on one side and Manhattan on the other. It's just these two extremely high value clusters of finance and IT. And if you ask, what is it about America that means that they're there? The answer is probably it's not an underlying thing. It's just that that's where they got started, and it's a self-reinforcing. It's agglomeration economies. And from the point of view of the world, there has to be a Silicon Valley somewhere, or it's a good thing for the world anyway that there's a Silicon Valley somewhere, which happens to be in California. From the point of view of the world, there's a lot to be said for there being a Wall Street somewhere, which, because it goes back to the Erie Canal, happens to be in New York, and of course the UK. I was just doing some work on that. The UK has London. I mean, the UK outside London is substantially further behind the EU than people think. It's really, a lot of it is just the city. And this is not because, I don't think it's because the UK has more favorable regulations or policy, and it's not because Brits are especially good at finance. It turns out that 38% of the city's finance workforce is foreign-born. So it's just, but why is London there? Well, once upon a time you had a global empire, long gone, but London is still there. So these things are just happenstance. That's not even clear they matter that much. From the point of view of average U.S. wages, the fact that there are some, the fact that we've got Mark Zuckerberg and Jeff Bezos and Elon Musk may not do very much for most Americans. They're high income, they're resident in the United States, but does it really matter? So now that's probably not all of it. I think there's a lot of critique you can make, but one interpretation of the Draghi report. I highly respect Draghi. I even know him, and there's a lot of good stuff in there. But even if you look through their own numbers, a lot of it seems to be that what's happened since around 2000 is that tech and finance have gotten much bigger. And for historical reasons, tech and finance happen to be in the United States. So there may be less there than meets the eye.
Since you raised Europe, I fully take your point as a Brit as well. As a British-based money manager, that I benefit from historical reasons, not necessarily skill. But I was going to ask you about the euro. You've historically been quite critical about it. Obviously, we've seen a big rally in the euro over the last few months because everybody's piled into it at the expense of the dollar. I don't see any structural changes that make me feel that it's in a happier, safer place than where it was 10 years ago. Do you think that's unfair or just me being British biased?
No, I think that's right. First of all, important to make a distinction between the strength of a currency on foreign exchange markets and the strength of the underlying economy. Those can be very, very different things. The fact that the euro is up doesn't make it a better idea. It's just one of those things that happens. The fundamental issue with the euro, the reason that I was, a euro skeptic, cheered when Britain didn't join, cheered when Sweden didn't join, is that it's really, really hard to adjust to asymmetric shocks, things that hit some countries more than others, when you have a single currency and no ability to adjust exchange rates. So if you look at the euro crisis of the early 2010s, it was clearly necessary for countries that had been receiving lots of capital inflows, like Spain, to bring down their costs and wages relative to Germany. In the case of Spain, that took 5 years of grinding, painful relative deflation, very high unemployment. In the case of Iceland, which tiny country but did still have the kroner, it took a day. They just devalued the kroner, and that was that. So that's what you lose by having a single currency. When you gain some ease in transactions, Robin and I were recently in Italy and Portugal and still had a bunch of euros in our wallets and didn't worry about, you need to get rid of those because we were heading on to Holland and can use the same currency. There's a lot of transaction advantages, but is Europe sufficiently integrated and does it have sufficient other ways of adjusting to shocks to offset the loss of flexibility that comes with the single currency? And the answer is still pretty clearly no. Now, unfortunately, I don't think that's going to actually, barring another really big crisis, that's not going to change anything. Do you have roach motels in Britain? Famous, they can come in, but they can't get out. The euro is kind of a roach motel. Choosing not to join the euro was easy, has gone fine. I don't see any sign that the UK has suffered. Lots of things going wrong, but I don't see any sign that not being in the euro has been a problem. But actually leaving the euro, once you're in, is extremely difficult and disruptive. And if you give it any length of time, then the amount of speculation, the amount of craziness that will happen while you get your act together. I was just talking with some people about saying, do you understand how much reprogramming of the computers would be required for a country to exit the euro? This is just really hard. Actually, sorry, random historical thing. The last time we've seen countries depart a single currency is really old. It's the breakup of the Austro-Hungarian Empire after World War I. And what did they do? Well, actually, they closed the borders for 2 weeks while the currency change was undertaken. Can you close borders within Europe for 2 weeks in the 21st century? So the euro was a mistake, but it's kind of a fact of life. Sorry, I think we just have to live with it now, and there we are.
We've had a bit of Hotel California. I think we missed one of your choicest quotes from that ECB. You were quoted as saying productivity isn't everything, but in the long run, it's almost everything, which I think is absolutely brilliant. But in a non-consecutive segue, I'd like to go into cryptocurrency because I know you're a big fan.
I'm sorry.
Of cryptocurrency,
Wow.
because you're mentioning the euro, and not to mistake the fact that the price goes up, that there's an economy behind it. And similar maybe to the Trump tariff question, are there any positives you think that it's trying to solve, rather than asking? You've written extensively on your Substack, the crypto is for criming, which I think is also a very very good title. I'm quite pro crypto, but I'd love to hear if you could build any arguments with me, or if it's just for criming.
Okay, so all right, I've been on this for a long. I actually, I've been in many meetings discussing crypto. I've made a significant amount of money off crypto because I get invited to crypto conferences as the designated enemy, and give my talk, and everybody nods and say, "Okay, you're wrong," and but they give me a check in dollars. The question from the beginning has been, what problem does this solve? Why are we doing? What's the point of having a blockchain-based currency? What does it do that ordinary currencies or digital payment systems that use ordinary currencies can't do? And if it adds, of course, a layer of transactions costs, it's still. So the funny thing about Bitcoin was introduced in 2008. That's ancient. That's it's barely, smartphones had barely come into use. The Apple Pay was introduced in 2014. So Apple Pay and Venmo and so on are ubiquitous. The vegetable stand around the corner from me here will take Venmo. Crypto is basically not used for a legitimate business. There are still, I don't know how many times I've seen breathless announcements that some business is going to start accepting payments in cryptocurrency, and yet it always fizzles. El Salvador heavily subsidized an attempt to turn crypto into real currency. They gave people digital wallets for free. They pressured businesses to accept, and it's 5% of businesses say that they accept crypto, and it's not clear that they really do. So this is something that has just not worked. It doesn't seem to fill any hole, and it's awkward and expensive to use. The one real use case that we found for crypto is it is a way to make payments that can't be traced, or that people think can't be traced, because that turns out not to work as well as they think, which means it is a tool for money laundering, bribery, extortion, and yeah, that's a use case, but not exactly one we like. And if there was a really good use case for this, this thing's been around for 17 years. We would have heard of it by now. So I see nothing there. And of course now we have. Actually, my views have changed slightly in a couple of days before we had this conversation, because I would have said that crypto was unique in terms of being a channel through which you could bribe the president of the United States. But now that the who's giving it? Sorry, now that the Qataris are giving him a free jet plane, I guess that's not true anymore. But it is clearly being used overwhelmingly for nefarious purposes. So, if there was going to be a crypto revolution, this is not new stuff. This is a creaky old technology. It's just one step up from suitcases full of $100 bills, and it's just not. And they're basically, people. There's a lot of $100 bills out there, which shows that there can be a demand for something that has no legitimate use. But there's really no legitimate use for $100 bills, and there's really no legitimate use for crypto.
Can I just throw in a variation of that? So Tom and I regularly argue over purposes of crypto. And as you can see from the smirking, for anybody that's got the video, I would agree with your view. Can you see a case, though, for something like stablecoin? You mentioned early on that you thought perhaps the dollar may longer be the centerpiece. As you know, long ago, Keynes recommended Bancor. The Chinese have made noises about restructuring things around perhaps special drawing rights. Could you see something where we do get some kind of international agreement where there is an international currency that would look, using modern language, a bit more like a stablecoin?
Okay, I mean, stablecoins solve one problem with crypto. The problem with Bitcoin or its various imitators is that the purchasing power fluctuates wildly from day to day, and you can't really. A medium of exchange needs to be a reasonably stable store of value as well, and Bitcoin is not. A stablecoin is, which is okay. That makes it less. One of the big negatives goes away, but it's still not a. It's still unclear. What does it do that bank accounts don't do? And in fact, stablecoins are effectively banks, but they are loosely regulated or unregulated banks. Stablecoin issuers, Tether looks a lot like a U.S. bank in the a U.S. bank in the days when when bank notes were actually issued by individual banks. It looks like the Citizens Bank of Louisiana in 1850, and the trouble with the private banking era, I mean, those were all of the banks actually promised that their notes would remain stable in terms of gold, and that they would supply gold coins on demand. And sometimes they actually did, but sometimes they didn't because they were unregulated and were very frequently really did not have the resources to meet the demand if anybody had any doubt. And currency, a dollar bill issued by a private bank, in many cases would trade at a discount to dollars issued by better regarded banks, which kind of defeats the purpose of having a currency. And this is very much the same. And we've already had several disasters of stablecoin issuers turning out to be basically faking it. Random historical thing. Wildcatting. What were wildcat? We had wildcat banking. What that actually meant that people would open a bank, issue notes, but actually locate the bank, the place where you needed to redeem your notes if you wanted to, way out in the boonies where there were nothing around but wildcats. So it would be hard for people to actually get there. So I mean we are probably, despite we're probably about to have some framework for regulating stable coins, but it's going to be a very, very weak set of regulations, and it's going to be what it's mostly going to do is create some appearance of legitimacy for what is basically unregulated, unstable banks. So the best guess is that stable coins will be the new repo, that it'll be there'll be something that people treat, that functions as money until suddenly it doesn't. And that's not good.
I'd love to ask just for some advice, firstly, on some of for young economists and CFA members. I've been able to dig up some information on your career path, but I'd love to hear, what you value and what's been your north light along your journey. A lot of people find these podcasts really useful to get some reflections from world experts from all over the place.
Yeah, I'm not really good at giving life advice, I'm a substacker, but not, I hope, an influencer. I'm not going to suggest give people wardrobe suggestions or exercise regime or suggestions. Look, I did. I mean, I've had a great trajectory, which I don't think is fully reproducible for any. And partly the world has changed, but I do think that first of all, there's a lot to be said for early in your career trying to do stuff that is fundamental. I mean, I later in life I've been, I was a journalist. Now I'm essentially still a freelance journalist or of a kind, data journalism, if you like. But it does. If I were talking to a young person, I would say try to get in some basic research early on. It's I'm really glad that I had basically about 20 years of writing articles with Greek letters and funny diagrams for a select audience, because it helps to ground you. It helps to establish a certain amount of credibility, but also just don't stay with it forever. I mean, that's I won't tell you who, but there's someone I know who's actually very good and has in fact finally made the transition. But we used to say that that he writes a really good article every year, a really good academic paper every year, and we wish he would stop writing that paper and try doing something else. There's a limited window of time when you can be creative. It's also true that the world has become much more free form and amorphous. The world of economics has become free form and amorphous in a way it wasn't. It used to be that go get into get an appointment at an elite university, publish 5 papers in top journals, get tenure, and then you can branch out. And I now see a lot of people that I highly respect who have built really important careers in economics without going through the academic phase, who have gone straight into the think tank world and to some extent into the journalistic world. And that's not entirely new. Martin Wolf does not have a PhD, but it's much more possible now. And if I think about the people who the people whose Substacks or blogs I immediately read when they cross my digital desk, a lot of them are people who are not have never been part of formal academia, but still you need to do fundamental stuff. If it's all just 800-word opinion pieces, that's really ephemeral. I don't think it's good enough. But then paying attention to the world is a really big thing. And that's true even, by the way, if you're going the academic route. My big mentor was Rudy Dornbush, late Rudy Dornbush, who was founded modern international macroeconomics. And when I was trying to decide on a thesis, his advice was, okay, you need to spend the next couple of months reading anything but journal articles. You need to read history. You need to read the Financial Times, the Economist. You need to look at what's happening in the world, find out what's happening in the world that bothers you because it doesn't quite make sense in terms of what you were taught. And that's probably where you should focus your research efforts. And I think that's true. So there's an interplay. You really want to think some deep thoughts. I mean, you don't want to start out by writing papers about why was Section 232 of U.S. trade law written the way it was. You want to start by things like, why is there international trade? But then also be prepared to move on and make sure work hard, do stuff that's deep, but don't get stuck in ruts.
For a guy that self-proclaimed doesn't like giving life advice, that was pretty profound there, Paul. You mentioned a must-read some Substacks that you must read when you see them publish. Would you care to share your must-reads? I'd love to know what your reading list is.
Okay, so it's a lot. I mean, I'm reading a bunch of stuff, but thinking about people I'm reading. So for ever since the financial crisis, this guy named Mike Congel, who's never had an academic position but is at the Roosevelt Institute, who has been the best voice on understanding fiscal policy, austerity, what it does. And still, when I see a new thing from him, I really dive in. I'm going to neglect people, clearly along the way, but I've always been a intensely not just follower, but we interact a lot with Brad DeLong at Berkeley, who does macro and history and so on. Right now, I think probably the person I look to figure out what the hell just happened on trade policy is extremely young. I've met him. He's alarmingly young. A guy named Joey Politano, who used to be at Treasury for a little while, but just now has a Substack on trade. Jared Bernstein, who was chairman of Biden's Council of Economic Advisors, but interestingly got there without, I don't think he even has a PhD, and he certainly was never at an academic institution, but comes out of in the United States, we have this really quite vital world of, I guess you'd call them center-left think tanks. Economic Policy Institute, Center on Budget and Policy Priority. There's an alphabet soup of them, but they all do serious research, and in some ways have the time to work their way through. I'm sure that I'm grossly insulting some of the people I do follow, but it's clear that there's just not a young guy, although still Simon Wren Lewis in the UK has been one of my go-tos for tons of stuff for ages. So I'm sure that I'm missing some. I know that I'm missing a bunch of people, but that's the kind of thing you look for: people who actually know their stuff, can do serious research, but are also attuned to what's happening in the world.
I was at an event recently, and somebody, again, high profile, said the second most asked question they asked was, how was Russia paying for things now that they've been kicked out of SWIFT? And it would be interesting if you could have any thoughts on how they are financing their economy with everything's going on. And that would be the other one I would ask again about Russia. We as Western Europeans, focus too much perhaps on ourselves, but I'd love to know your thoughts on what the Russian economy looks like once the war starts to wind down, because it pretty much looks like a full-time war economy with a big shock coming when it all sort of finishes. But look, that's my personal request. Is there anything else?
Those are good questions, and exactly the kind of thing where I'm not going to start pontificating based upon no idea. But I actually think that the question of how Russia is managing without SWIFT is a really interesting one. It actually has some clear bearing on the question of what happens if the dollar is no longer, if Treasury bills are no longer considered safe. How do you manage a payments mechanism when the mechanism that you've been relying on has suddenly stopped working?
Totally agree. Paul, was there anything else you want to plug? Because we're drawing to a close. We've had a great conversation. Thank you very much for your time.
No, I mean, I'm just one thing, kind of cosmic thing, is how much does the fact that crossing borders no longer feels as safe as it used to be. What impact is that going to have? I mean, we've in the U.S. Tourism is a surprisingly big export, and it's plunging, not because of countervailing tariffs, but because people just don't feel good about visiting the U.S. But one of the things that we know about international trade is that distance is still a really major factor in determining how much trade there is between two countries. The gravity model always puts a really large weight on distance, which is hard to explain in terms of concrete transportation costs. They're really not, the transportation costs are not enough to explain why distance matters as much as it does. And the best guess is it has to do with personal interaction, that the ability of the vice president to fly out to the factory and find out what happened to quality control or whatever is a big deal. The world has gotten a lot bigger now because we're all kind of scared about travel. And what will that do? And that's a longer term issue. I think it's going to wait a little while on my stack of things to do. But I think that's an interesting question.
Cool. Thank you. Tom?
I was just going to thank you very much for your time. I've had a fabulous conversation. We've never had a podcast guest where we've asked them if there's anything they want to plug, and then they've framed back a very big question. But the whole conversation has been an absolute delight. Thank you so much for your time today, Paul.
Okay, take care.
Cool. Thank you, Paul. Thank you very much for your time.
Thank you.
And thank you to everyone for listening. Remember to look out for the next episode of our Future Proofing Finance podcast through the usual CFA UK email and social media channels. You can also subscribe so that you don't miss any episodes through CFA UK's SoundCloud channel or Apple Podcasts. Until next time.